Hello, everyone. We're here with another episode of StableSchool podcast. I'm here with Sam Kazemian. Did I say that right?
Yes,
no, I did
Kazemian.
not. Okay.
Great.
Sam from Frax. Sam, please introduce yourself and then we'll get into it.
For sure, yeah. My name is Sam Kazemian, founder of Frax, and been in the crypto space since actually over a decade now, since I was in college at UCLA, mining like Bitcoin, Dogecoin, altcoins, and started Frax in 2019 when I thought that before any of the words like DeFi or anything was like actually, coined, I thought that, cryptocurrency is kind of a misnomer because few people used it as a currency. And they're good investments, which by definition means that if something's a good investment, you should be able to sell it for more currency, which is usually stable to some standard of living, right? And so from those thoughts and that kind of philosophy, started Frax. And Frax has actually grown a lot since then. We launched in late 2020. Frax now has its own L1 blockchain called Fraxtal. It also has like a wide ecosystem of DeFi primitives as well. And then there's a lot of builders building on the Fraxtal chain. And we recently launched our new roadmap for our fully collateralized, institutional-backed Frax USD stablecoin, which I think is the future of finance.
Yeah, so let me know if I captured as well. So Frax started out as a stablecoin.
Yes.
And then basically, I have a little bit of a technical background, so I'm just like curious. How did that work? Like, which chain did you launch on? And then how did that transition go to like becoming an L1?
Yeah, so I mean, Frax has grown way more than I ever imagined in the past 4 years. This December will be its 5th birthday. And originally, Frax was built on Ethereum. It was like in the heyday of DeFi summer. It had a very unique decentralized stablecoin system where basically part of the Frax supply was backed by volatile assets, including the volatile Frax share token, and then also by other stablecoins and stable assets. And then as Frax grew over time, the ecosystem expanded. So we like partnered with Curve, Convex, a lot of the household names in DeFi as we kind of became our own household name in DeFi for yield farming, yields, liquidity, and basically DeFi mechanism design. And so when we launched Fraxtal Chain, it actually originally was an L2 running on the op stack. And the idea is like it was a DeFi first, high performance EVM L2. We recently upgraded so that the Frax share token is just called Frax now. And it's the gas token. It is the commodity token of the Fraxtal chain. And everyone that's building on it is now going to be able to enjoy faster block times up to 10 millisecond intervals. Wow. And basically a fully brand new chain technology, as well as it sets up our Frax USD real-time yield streaming system and our roadmap for our payment stablecoin issuance.
Okay. We were actually discussing a hot topic, like just offline, and I want to get into it. Like, you don't want to miss this. But I wanted to get your take a little bit, and maybe going off script on this whole chain wars. Like, full transparency, I'm with Scroll and L2, ZK rollup, and we're out here building our ecosystem. We started at a time where, ZK rolls were the hot thing. ZK is the end game. The world has changed. Especially you guys going to an L1. What's your take on the whole chain business?
Yeah, I mean, so we're very Ethereum aligned in terms of the ethos, the culture. I originally built Frax on Ethereum mainnet. I guess it kind of depends on your, exact semantic definition. Like there's still an enshrined bridge to Ethereum on Fraxtal because it's the most liquid place for DeFi. So you can still bring and take tokens back and forth, not just Frax tokens, but everything else is essentially an L1 with the Frax token as gas, as proof of stake, providing security. I think that from the chain, chain topic, I actually have this kind of interesting, controversial view that all chains actually are app chains, and there's no such thing as a general purpose chain. And the reason I say that is like Bitcoin is a single token chain. It is optimized for a single token to be a store of value and do nothing else, which is great if you want, this one token to be a store of value, right? Fraxtal is optimized to be a DeFi and real-time yield streaming and payments chain where you could build financial primitives around the base money. I think that the time where, the general purpose technology chain, you have this cool idea of like a Stark circuit, right? Or like a new way to create a ZK rollup. I think that that's past. And so all of the chains like Scroll, like Starknet, like, Polygon, ZK, EVM, they basically grandfathered and they're allowed to kind of exist, so to speak, and grow. But I don't think without a very unified, direct vision of like why a chain should exist, there will be any general purpose ones. And in terms of like, oh, we have like even a slightly better incremental circuit that like is even faster at proving times. I think that's basically over. And so the reason I say that is the performance technology is getting much better. Like Fraxtal is going to have 10 millisecond block times because of a modified version of flash blocks in our EVM system, right? And so it's going to feel real time, just like Mega ETH, just like Monad, for example. There's not going to be that much differentiation among the open source technology improvements, for example. And the real thing is, what is this optimized to accomplish? And I'm a pretty big proponent that there should be a lot of chains, but for specialized specific purpose, right? And so like, for example, you could argue that like Ethereum itself, the most general purpose chain, is kind of a settlement app chain. It's like a DA settlement and app chain, right?
Very common theory. But it's very curious because you said Frax is positioned to be like a payment / like stablecoin, I would say, chain that yield streaming for the stablecoin. How does low latency help with that? I mean, I can understand the streaming side of things, but like generally speaking, on payments latency.
Yeah. So one thing that I would actually like compare it to is if you remember Facebook's Libra, they came out in like 2019. Idea way before its time, but a brilliant idea where there was basically an L1 like Libra chain, which actually is kind of where this whole move stuff like originated. And then look at all of the L1s that like the Libra project gave birth to, right? But the idea of the original Libra chain was you have this issuance hub chain, and then you have this Libra stablecoin, like Libra USD or whatever it was supposed to be called, right? And you issue the Libra USD on this L1, and then there's like some proprietary message passing layer, kind of like with Circle's CCTP. And like that's Circles, right? They're probably most likely, if they launch, going to have something like that. We actually do as well. We have our cross-chain mesh. So we issue FRXUSD on 15 plus chains natively, and then you can move it around in seconds. But what actually happens is the message passing goes through Fraxtal chain. So for example, if you have FRXUSD in Sonic and you want to go to like Bera chain, for example, what really happens is on the back end, it goes Sonic to Fraxtal chain, and then from Fraxtal to Bera chain in terms of the message processing. On the UI, it's super simple. You just click, one-to-one, from Sonic to Bera chain, and then in seconds, your FRAXUSD tokens are there, and you don't need to see anything, right? But this settlement and hub chain model, where it's a very fast chain, it's a very secure chain, and it is very cheap in terms of messages, essentially transactions, to process, is kind of the centerpiece of the full stack of money. And one of the other important aspects of having your own chain while being a major stablecoin issuer is that you're able to actually capture flow value rather than just stock value. So there's two value theory of stablecoins, stock versus flow, where any stablecoin issuer that doesn't have its own chain, they can only capture the stock of the T-bill yield or the backing yield, whatever it happens to be, that is not passed on to users, whether it's through like a yielding token or through incentives or through some other spend, right? And then the leftover is like their monetizations, the stock monetization of the balance sheet. The flow monetization is what, most TradFi people are used to calling interchange fees, right? Like when you swipe a Visa card and you pay $100
upon moving the transaction fees that you get or whatever.
Exactly. And so if you're a stablecoin issuer like Circle or like Tether, that you don't have your own chain, you will never capture your flow value, right? People using this as payments. Whereas with Fraxtal and FraxUSD, those are unified as a full stack of money, kind of like the Libra vision, right? And I think that's very powerful. And to be honest, I would say here on this podcast for like historic sake that I think Circle and Tether are working on that right now in terms of having a chain where they are able to capture the flow. So like we already know that Tether's made a very big investment in Plasma. And then recently Circle has made a huge both investment and ownership stake in Codex, which is a different chain. And both of these have kind of a quasi-enshrined integration with respectively USDT and USDC. The good thing is with Frax, FRXUSD and the Fraxal chain are as unified as possible. And there's only one token distribution, the Frax token, which we actually recently upgraded and we removed the share name. So it's just literally just Frax, and it's the staking and L1 token on Fraxtal, and it gets both stock and flow, right? The T-bill yield for the floating FRXUSD that's just used, and then the flow of all transactions that go through Fraxtal, predominantly obviously for the FRXUSD, but anything, right? Deploying contracts, everything that you can imagine, just like a normal chain.
Very, very interesting. So quick check. Frax today, no longer a stablecoin. It's the native gas token for the L1 that also provides you yield, or is that not the correct way of framing it?
No, that's correct. So originally, there used to be a decentralized stablecoin called Frax. We've deprecated that and allowed everyone to migrate to the new, hopefully soon to be fully regulated in compliance with US regulation called FRXUSD, so FraxUSD. So that is the single stablecoin going forward. So everyone that uses dollars in the Frax ecosystem should use and does currently use FRXUSD. That opens up the original Frax ticker and name. And then the Frax share token, which is the only token in the entire Frax ecosystem. We don't do sub-DAOs. We don't do tokenization of our ecosystem, Frax Lend or Frax Ether or anything. Everything is a single token distribution. We simply remove the name share from it, and it's just known as Frax. And so obviously the ticker and name are just Frax. And if you go on Fraxtal right now, and you either bridge your old FXS tokens or you upgrade them, you'll just get one-to-one new Frax tokens, and those will be essentially the scarce commodity, the staking token that powers everything, that earns everything, that is partly burned for gas fees, and it's able to do other things like get .frax usernames and all of the good ecosystem things all run on one token. So there's no fractured tokenization of. We basically believe in this kind of commodity, scarce, singular token distribution where everyone is aligned. So you don't have bunch of very, very small sub-DAO kind of things. We think if you're a third-party project, like an ecosystem, we love to support you. We love to do token swaps. You should have a different token, obviously, completely external to the Frax chain issuance and these things. I'm very pro token, but I'm very singular. People call it Fraximalism in the Frax community, like Frax maximalism, like BTC maximalism. And I'm very pro that in terms of there shouldn't be the ability or even reason for a single brand, single Lindy, household name to just have a bunch of tokens, because it's short-term profitable, long-term against both community interest as well as the chance of success of the whole thing.
Yeah. I'm thinking right now the two directions I want to go in, and I can see us filling up the whole time. I think Zach will hear me screaming a bit. But I really want to know, like so we spoke about events and non-events just now, i.e. in an industry, stuff is happening. Is it something that matters? Is it significant or not? Is it something that moves the needle or disrupts? We spoke about something offline, but I want to talk about something else. UCC, for instance, look at Codex. Do you see them as a competitor that will like swipe everything away? Because I didn't look at it like that, where UCC would actually capture flow as opposed to just store a value by investing in Codex. Is that going to be like Codex, and they're going to also focus on a bunch of other chains where they're going to capture like the flow, or are going to like have one chain where they do it like Frax? Frax is basically, that was the reason behind going to an L1.
Yeah, so obviously I have no idea what Circle is technically planning. But what I will say is, like, if you're an issuer of currency, like we are with FRXUSD, like Circle is with USDC and Tether is with USDT and et cetera, you want your token to be in as many places as possible, used as money. Clearly, it's in your interest, whether you can capture stock or flow. At first, it's irrelevant because you want it to be used in as many places as possible. Because by definition, money is more valuable the more places accept it. The next marginal, acceptor or user is more likely to use it if everyone else uses it, right? That is by definition, it's in your interest for it to be everywhere, which is why we issue FRAXUSD on 15 plus chains and counting, and we have our own cross-chain messaging mesh that you can take it to and from one-to-one in seconds, which is very, very fast. It's like CCTP, but on steroids, I like to say. And the next thing, though, is that you do want a place where you can offer fast settlement that you have control over, and that settlement that you can potentially give back to merchants and integrators as a perk, essentially, as a reward, right? And so that's how traditional financial structures with like Visa, with like bank payments and things like that work, which is like in Visa, like and MasterCard and Amex and stuff. When you go to a merchant, you swipe it, the merchant usually pays some interchange fee, which in traditional DeFi talk, it's basically the validator fee, right? It's the transaction fee. You want to be able to have some control over modulating that constant, at least somewhere, right? Like you obviously aren't going to have control over that when people are using your money on Solana or on Ethereum or like on Binance Smart Chain. But if it's on Fraxtal, we have control over like the Frax token holders, right? We have control over actually being able to suggest different features and opcodes for the actual chain level settlement, right? Yeah. So like one of the things we're looking at is, can we actually offer free, no gas at all transactions for FRXUSD by having a separate mempool? And so, for example, wallets that hold FRXUSD, the protocol is capturing the stock value, right? Let's say you have 10,000 FRXUSD in your wallet and you're not earning the T-bill yield, as an example. The T-bill yield essentially is being captured by the Fraxtal chain validators, the Frax token stakers, right? They should be able to and willing to allow you to send a lot of free transactions up to the amount of the T-bill yield that they're earning, the validators are earning because of your balance, right? And so we're experimenting with these kind of zero fee settlement transactions. And so think about how interesting that would be for merchants that never will have to pay 3% Visa fees, right? You can't do that on Solana. You'd have to do something where like you buy Sol tokens and then you pay for the gas in some kind of clunky way of like, and then also like I'm big on like account abstraction and stuff that's coming out in the Ethereum ecosystem, but it would not be as smooth as something that's tailor-made for payments, right? And so you want this place where you can actually experiment and innovate on your own chain.
100%. Very, very interesting. I think that, last time we held these podcast series, I really got some clarity in framing some of my thoughts. And this time is like, the capturing of the flow and the capturing of the stock, as you mentioned, that's a very clear one. I do want to touch upon something we spoke about offline. So we spoke about events, non-events. in the industry, a lot of noise, a lot of stuff happening. And we just spoke about something. I actually want to give you the mic and being like, you think something big is about to happen.
Yes, and in stablecoins, which is what is the U.S. legislation, otherwise known as the Genius Act or Stable Act is another name for the House bill. That's actually why I'm here in Dubai, and my keynote is about Frax's new roadmap that's focused on this area and making sure FRAUSD is the first chartered payment stablecoin to hopefully exist. So the main thing is that there's two bills. For lack of a better term, let's just say there's one, because usually the U.S. legislative process, they reconciliate into like one, and then it goes to the president's desk if there's enough votes. And so there's essentially a stablecoin bill. And what it says that everyone is missing, in my opinion, that we were talking about, is this is a much bigger deal than just a regional, like VARA here in Dubai, the virtual asset regulatory body, right? And then MiCA in Europe, because the main thing that this says is that the issuer of the dollar, which is the United States of America, right, has a law now that says if you issue a token that looks like this, behaves like this, is backed like this, the company that issues it is like this, X, Y, and Z, then that token is not just a stablecoin. I mean, there's a legal term in the bill called a payment stablecoin, but then it says payment stablecoins are legal settlement media in banks. Banks can accept them as deposits. Essentially, they're like M1 money. And for people that probably know, since they're looking at stablecoin school video, it's literally legal tender, essentially, digital cash. And so that is a very important thing that I think most people are not thinking about, that we are entirely, our flagship roadmap with FRAXUSD is focused on. Like, we're very big in making sure that Frax is at the forefront of this in like DC and being able to comply and get this payment stablecoin charter. And the big thing is that if a company gets this payment stablecoin charter, which is different than a bank charter. So for the first time, you could just have like a C corporation. You could just have a company. It's actually in the bill. It says non-bank payment stablecoin issuer company, which is literally just defined as a legal company in good standing in the United States that applies properly, right? You can issue M1 digital dollars that the government of the United States, which is the issuer of the dollar, essentially recognizes as digital cash. And why that's important and different than any other stablecoin like regulatory thing in like Dubai, Japan, Europe, and all this stuff is that all of the other places, they don't issue dollars, right? So if they do business with dollars, like their banks accept dollar deposits, their merchants accept dollars, they have to actually accept anything that the United States sees as a dollar. They can't differentiate between it. They don't have to show it's like a stable coin deposit or something, right? But if something is a dollar, European banks accept dollars as deposits, right? Yeah. And that's the main thing that I think people are missing, which is like European banks can accept, they won't even be able to tell the difference between a payment stablecoin and a normal CD, certificate of deposit from a US bank. One just has like a piece of paper as a certificate that's online, and then the other one has a ERC20 token or something that follows to the destination deposit, right? And so that's a huge deal because people have it reversed, where in like Europe, a dollar in the European banking system is called a euro dollar. The reason it's called a euro dollar is because it's not a dollar in the United States. If it was, it's just called a dollar, right? Yeah. And so the important thing people are missing is that if you can actually be one of the first payment stablecoin issuers, which Frax is aiming to be the first, I assume Circle and like, you know, Paxos, maybe PayPal, USD and stuff are also at the forefront of this. You can actually get your stablecoin accepted pretty much anywhere that accepts dollars and help convert the old M1 money in money market accounts, in banking, checking, and savings, in all of these places into a digital dollar that's now legally regulated, legally recognized. And then with our unique system that we're actually announcing soon, later today, where yield is real-time streamed on Fraxtal, you can use this digital legal tender as dollars, but also earn real-time risk-free yield of the underlying. And so you have this like perfect, legally compliant, legally safe, best payment like medium in the world because it's settled anywhere 24/7 that has an internet connection. And also you never have to give up your risk-free yield for using it. So I think that's first of all, that's our most important roadmap, is working with institutions to convert the older M1 money supply to Frax USD and real-time yield. But the main part of your question about what is an event and a non-event, I think that people don't realize that should this payment stablecoin bill pass, which it's looking like it will around the end of July, that is probably the biggest event, in my opinion, in crypto regulation ever historically.
Yeah, because let me summarize what you said, like from my normie brain point of view, which is basically a stablecoin is no longer treated as a stablecoin; it's treated as a dollar.
Yes,
and it's accepted as a dollar for whoever gets on the charter, i.e., whoever like the government like puts on a list and says this is now like USD whatever, CT whatever, they are now accepted as dollars.
That's correct. Like if you think about it, a deposit in a bank is technically not literal like dollars. They're liabilities of a bank, right?
Yeah.
But legally they're dollars. They're able to be wired to and from, other banks and
yeah.
Everyone for all intents and purposes, because it's backed by legislation, FDIC insurance, which is a federal legislation act. It's all treated as dollars, right? After these bills, stablecoins, in fact, one of the backing of them can be certificate of deposits at banks, right? But then there's other backing as well, like Federal Reserve reverse repos, T-bills, 2A-7 money market fund accounts. Those backing a digital token is seen as a dollar, which is very, very different than anything else.
Yeah, and so one of the practical implications I love that you told me offline is that if you have shares in through a money market fund, you can basically mint or get like a stablecoin representation of that supply.
Yeah, so one of the things Frax is working on is like we want to allow the easiest conversion of old analog cash, as I would like to call it, to new legal tender digital cash with real-time streaming yield. Basically upgrade the old M1 money supply. And so Frax USD can already be minted by our institutional partners like BlackRock's money market fund. They tokenize as BIDL. Superstate. Wisdom Tree was onboarded recently, and they have hundreds of billions of dollars of money market fund users, right? Fidelity is actually in the process of onboarding so that we can have Frax USD mintable and redeemable with Fidelity's money market fund. Again, hundreds of billions of dollars of people saving in these analog forms of cash. If we can provide a proper platform and SDK where, for example, Fidelity can integrate the Frax USD SDK into their brokerage, right? And so when someone logs in and they have, $100,000 in a money market fund account that is earning them yield, but they can't use it as payments. It's a security. When they need to use it as payments, they have to sell all of it, which is bad for Fidelity, right? Because they lose AUM and then they have to deposit it to their bank checking account or Venmo or whatever is their preferred form of payment. But instead of that happening, imagine if, for example, Fidelity could have a button that says, try saving in new legal digital dollars powered by Frax USD. And so you can click that and then you just move your $100,000 worth of money market fund to a Frax USD minting contract, and then you get 100,000 Frax USD. And then from that moment, you see the actual balance be live streamed to you. So now you have a great payment legal tender token that you can send to anyone. You're not losing any yield. And Fidelity doesn't lose any AUM because they still hold the underlying custody of the of the T-bills, and so they don't ever have to worry about people selling their money market fund account to make payments.
So will we ever see a world where, let's say, I hold Tesla shares and I get to mint stablecoins against it?
I think there's a world where you can borrow against it. You can't. You can't mint it against it if it's a payment stablecoin. So there's very stringent guidelines on what is actually considered legal cash, because it's a very powerful distinction. But definitely I expect, like, securitization platforms like Securitize that we work with. Ondo is another group that they're looking into tokenizing securities. There's a whole host of others as well. And so I think the day where Tesla stock or like NVIDIA stock is like a RWA token or a security, there will probably be ways that you can just borrow FRAXUSD against it. Not necessarily mint, because FRAXUSD can't be backed by securities that aren't old M1 money. But there's definitely going to be a lot of, I think, like a DeFi renaissance, but with new RWA tokens.
Is that where you think the next wave will be? Stablecoins, RWA?
I think so. It requires some of these laws passing, though, and so I think the first one, hopefully in July, and hopefully market structure by the end of the year. But we'll see.
It feels like we're losing touch with what money and currency is. Maybe like the associations we have, right? Like I have a TradFi background. Money minted against gold. We have a gold reserve. We have like actual like assets back, and now it feels like we're going full circle, coming back. Having like currencies or securities back, or different kind of assets back. But then, yeah, does that make sense what I'm saying? Or
are you saying like we're kind of recreating the like original financial system?
It does feel like on the one hand, it feels like we're recreating the original financial system, where it's pretty cool, where it's securities. I actually do see it going towards a world where, whether it's a decentralized stablecoin or a licensed stablecoin, you'll hold assets and be able to like, sort of like trade it or redeem it or provide it as collateral to get like stablecoins. But at the same time, stablecoins providing collateral for other stablecoins, where does it end?
Yeah, well, I mean, there's going to be all of the original like financial like structures that are useful for people, rebuilt with more efficiency and more, less roadblocks and bottlenecks. And so, for example, one of the things that I kind of point out is, right now, in the way that a bank works is, if you bring $1 million of cash to like a bank and you deposit it, your account will say $1 million when you log in, right? But then the bank takes like $500K of that like $1 million, and then they lend it to someone for like a mortgage so that they can buy a house, right? If you log into your bank tomorrow, it's not going to say $500K, even though like half of it is gone. It's to say $1 million, right?
Yeah.
But now when that guy logs into his bank about to buy a house, it'll say $500K, right?
Yeah.
And that's, for example, how money is hypothecated. What's really interesting is, for example, after the payment stablecoin bill, you can deposit like 1 million FRAXUSD after it's chartered, hopefully. And the bank will show you have $1 million, and it'll go and do the same thing. It'll lend 500,000 FRAXUSD to someone else to buy a house. When you log into your bank, it'll still say $1 million because of your original million FRAXUSD deposit. All of these structures are going to be recreated again because they're useful for society, but they're going to be more efficient, and they're going to be less, pen and paper or COBOL databases or these kind of things. And I'm actually for that. I don't think I'm not like the fundamental activity of like investment and credit creation is bad. What is bad that this will thankfully fix is banks had a privileged monopoly position where you had to deposit your money into a bank, and a bank was given the like state like approved ability to be like the sole credit creator and privatize the gains and then socialize the losses when they fail, in like 2008 and as recently as like SVB and stuff like that. This will change that, because Now, payment stablecoin issuers are for the very first time, hopefully, are going to be a second source of M1 digital money issuers, which, again, we're talking about events and non-events. That is as big of a historic event, I think, that you can really even think about since the dawn of like the banking sector in the United States in the 1800s, like in the mid 1800s.
But still, like intuitively, two things. It feels like, and I guess I mentioned this offline as well. It feels like the dollar is like, it's like being reprinted, as in like you get like $2 now in circulation as opposed to like, $1. And then, but the second thing as well is, I'm getting a little bit 2008 vibes, and maybe I'm just not understanding it. Could be. It's like, when we now have a larger supply to tap in that is back against the same supply that's there in the bank or like wherever out there, right? And then we do the same thing over again. So I'll give you an example. Let's say FRAXUSD. What is the ticker? FRAXUSD?
FRXUSD.
FRXUSD, is now accepted at, let's say, my local bank. Deposit $1 million, but that FRXUSD is backed against, let's say, the same dollars that are, let's say, held by that bank. Let's say if they will be minted like in that bank. So now, that bank like has like $1 million worth of my FRXUSD, but the $1 million that is utilized to mint the FRXUSD is also reutilized. It's not held there locked up.
Yeah. So that's why the legislation is like very stringent. When you asked about, for example, securities, like can I mint FRXUSD? And I said, no, not if it's a payment stablecoin. The types of collateral that you can actually create a payment stablecoin are very stringent. They're 2A-7 money market fund, which just means short-term treasury bills, certificate of deposits at banks, which means only one level of extra money creation, right? Like FRXUSD.
But the question is, what can you do with the collateral? Are you allowed to?
No, so you can't touch them at all. So you're right that one layer of additional dollars are created through payment stablecoins, but payment stablecoin issuers can't hypothecate them. They can't touch them in any way. In fact, they literally just issue legal tender digital dollars. The banks can hypothecate them. So that the banks that, in my example, if you deposit $1 million FRXUSD in your bank, they'll show that you have $1 million, and then the bank will turn around and like lend 500K of it to someone else to buy a house. The bank is allowed to do that. That activity is only restricted to banking chartered U.S. banks, not payment stablecoin issuers, which are totally different entity and activity.
Right, but what if so this depends on the payment stablecoin issuer who they're partnered up with as a custodial service. If the custodial service is provided by a bank, could they hypothecate the underlying asset?
Well, the bank can. The bank can, but not the payment stablecoin. So, for example, let's say like FRAXUSD works with Citibank, right? And Citibank says that we're going to take $1 million of our deposits and mint $1 million FRXUSD with them, right? The deposits that are backing FRXUSD, they could be hypothecated, relent, and things Citibank can do stuff with them as legal as possible, right? They can start doing hypothecation, I think, up to 9 times, right? We can't, as like the issuer of FRXUSD, but the backing of FRXUSD is certificate of deposits. Now, payment stablecoin issuers can decide what they want to actually back their thing in the list. So like, for example, FRXUSD right now is not actually backed by any bank deposits. It is just treasury bills, short dated, held in regulated institutions as 2A-7 money market fund accounts, and tokenized on chain so people can see them transparently. So you can have payment stablecoins like FRXUSD that are so sound that they don't even back themselves at all with any deposits at banks.
Yeah. It was also hypothetically speaking, I guess, like what if, the custodial service was a bank, but that would mean that that's just like on steroids now, like underlying asset being like loaned out again, as well as, because a bank could do that. But
I actually think that higher the velocity of like M1 money, the more likely it is that there will be like economic productivity, investment, and like growth. Because right now, if you look at the like M1 money, it's about 20 trillion as reported by the Fed. Not all of it is very easy to use, right? Like money market funds, they don't move. You have to unconvert them, and then you get them as cash. So then they are no longer money market funds. So then you can like invest them. But if all of that amount, right, was digitized as like legal tender payment stablecoins, or even half of it, or even like 30% of it, right? Like 6 trillion of it, right? The amount of money in the economy that like this unlocks, that people can pay, invest, use, and not miss out on the risk-free yield, that should actually, technically, translation-wise, increase risk asset prices, stocks, crypto, all of these things, because the higher the velocity of money, even with like a fixed amount, it's almost certainly to essentially de facto be like there's more money in circulation, just like when they printed trillions for COVID. But there's structural like fundamentals to the velocity increasing, but not the supply. So it's like a good effect without the potential crazy inflation like kind of effect. So I'm actually very bullish this bringing a lot of productivity to like the financial sector, as well as like internationally giving a lot of people access to the dollar, which Tether's done an awesome job at. Right, they're really good at bringing dollars. That's actually their GTM, right? The way that I would describe Tether is Tether's GTM is bringing dollars to underserved, underbanked ecosystem sectors and entities. Originally, it was like centralized exchanges, right? Because they were new, and so that's why Tether is on all the centralized exchanges. But even more so, it's like third world countries, the developing countries that don't have full like USD banking access and things like that. Circle's GTM is like they want to connect fiat rails in essentially the West to on-chain DeFi and the on-chain crypto world. That's why you see USDC really dominant in most of DeFi, because it originally came out of Silicon Valley, supported by Coinbase, built in the United States. And their goal is to essentially connect the analog rails, as I like to say, to the on-chain DeFi rails. Frax's GTM is slightly more nuanced. It's that now there is a legal ability to convert the old, rather than bridging them like Circle. You can actually provide a seamless way to convert the old digital money into the new one and make every part of the new digital dollar better, from real-time streaming of yield to, obviously, on the payment side, you don't have to do much convincing. It's just objectively superior, right? Like you send it to anyone in the world in a non-custodial manner across like seconds, right? 24/7, 365. And so when you look at it from like an objective perspective, these three kind of GTMs are the multi-trillion-dollar opportunities in stablecoins. And then you can build decentralized, stablecoins on chain with these big type of like fiat coins as like the kind of de facto dollars, right? You can create PSMs, you can create all of these things, and those are kind of like the M2 money.
We've run out of time, but this was super interesting. I think I don't need to ask you for your hot take or insight, because you're given a big one that's on the horizon. I actually wanted to double click really on. I still think that the way you explain it, yes, velocity with not the impact on inflation, and yet I see a big risk. But maybe we need to leave that for the next episode. Sam, thanks so much for joining me. It was a pleasure. Fun in Dubai.
Thank you.
Thank you.